Hey everyone, and welcome. If you're gearing up for any of India's competitive exams, you're going to want to listen closely. We're about to break down the Banking Laws Amendment Act of 2025. This is a huge deal, and trust me, it's practically guaranteed to show up on your papers, so let's make sure you're 100% ready for it. So let's start with the big question. What exactly are these massive changes? And more importantly, why should you care? Look, this isn't just some minor tweak. It's a complete overhaul of India's banking system, touching everything from the big shot decisions in the boardroom all the way down to the services you use every day. You can bet the examiners are watching this one like a hawk. All right, here's our game plan for today. We'll kick things off with a quick overview, lock down the key dates, and then dive deep into the two main phases of the rollout. We'll also touch on a few technical changes before we hit the final, most crucial part, a rapid-fire revision to make sure all this stuff sticks. Okay, let's jump right in. First up, the big picture. Before we get lost in the nitty-gritty details, it's super important to understand the why behind this whole thing. What problem was the government trying to solve here? Getting the logic behind it will make all the individual pieces fall into place. So, what was the mission? Well, it all boils down to these key goals. At its heart, the Act wants to beef up bank governance, give better protection to depositors and investors, and seriously improve the quality of audits, especially in our public sector banks. Oh, and see that one? Customer convenience. Circle that, highlight it, because that's a theme we're going to see again. These are your buzzwords, folks. Perfect for framing those descriptive answers. Now, this is a big one. This single piece of legislation is actually changing five major existing laws. That's a massive move. So how do you remember them all under exam pressure? Simple. We've got a little trick for you. Just remember RBSBABA. That's R for the RBI Act, B for Banking Regulation, S for the SBI Act, and then the two Banking Acquisition Acts, BABA. Easy, right? Okay, next up, dates. And you know how much exams love dates. This act wasn't a one-and-done deal. It was rolled out in stages. So understanding this implementation roadmap is absolutely critical. Let's get into it. 3 dates. That's it. Burn these into your brain. April 15th, 2025, that's when the act officially went on the books. Then, August 1st, 2025, Phase 1 kicked in, all about governance and audits. And finally, November 1st, 2025, Phase 2 rolled out with new rules for customers like us. All right, let's dig into Phase 1, which started on August 1st. Pay close attention here because this stuff is gold for your mains exam. We're talking about the core changes to how banks are run and how they're checked. Now, before we get to one of the most shocking changes in this act, we need to get a key term straight: substantial interest. In simple terms, this is about how much of a financial stake someone has in a company, enough to give them real power or influence. It's a fundamental concept to prevent conflicts of interest, and you're about to see why it's such a big deal now. Get ready for this. The old limit for substantial interest was just 5 lakh rupees, and that number hadn't been touched since 1968. The new act jacks this up to 2 crore rupees. That's not a typo, that's a 40 times increase. It's a huge jump, but it makes sense when you think about it. It's basically just catching up to over 50 years of inflation. This is a classic data point that's just begging to be an objective question. But wait, there's more in Phase 1. First up, for cooperative banks, a director's term is now longer, going from 8 to 10 years, which should hopefully bring more stability. Next, public sector banks now have to move any unclaimed money that's been sitting around for more than 7 years into a special fund. And this is a game changer. PSBs can now decide for themselves how much to pay their auditors. The idea is to attract the best of the best and really improve accountability. You're probably wondering, what's this IEPF thing we just mentioned? Well, it stands for the Investor Education and Protection Fund. Now, the fund itself isn't new, but making public sector banks contribute to it is. It's basically a big pot of all the unclaimed money from investors, and that money is then used to teach people about safe investing and financial literacy. A really positive step for sure. All right, moving on to Phase 2, effective November 1st. This is where the act really starts to affect you and me directly. It's all about making things easier for the customer, especially when it comes to the rules for nomination. This impacts pretty much anyone with a bank account. So the act brings in 2 cool new ways to nominate people: successive and simultaneous. Think of successive like a line. You can say, my spouse gets it first, and if they're not around, then my child gets it. Simultaneous is all about sharing. You can split the money, say 60-40, between 2 people. Now, here's the part you absolutely have to remember for your exam. Simultaneous is only for deposits. Successive nomination, on the other hand, works for deposits, lockers, and safe custody. Don't mix those two up. So how does this successive nomination actually work? It's pretty simple, really. The first person you list has the first right to the claim. If, for any reason, they can't claim it, the right just automatically rolls down to the second person on the list, and so on for up to 4 people. It creates a really clear chain of command, which should make settling claims a whole lot smoother and hopefully prevent a lot of family disputes down the line. Okay, let's get a little technical for a moment. We're going to talk about some changes to how banks report their data. Now, don't let your eyes glaze over because this is prime material for those tricky objective questions that love to catch people out. The old system was kind of messy. Banks had to report their numbers to the RBI on each alternate Friday. It was a bit vague. The new rule cleans this all up. Now, everyone reports on the last day of each fortnight, and they've even defined what a fortnight is. So why does this matter? Well, it just means everyone's on the same schedule, which makes it way easier for the RBI to get a clear, consistent picture of what's happening in the economy. All right, deep breath. We've covered a lot of ground. Now, for what might be the most important part of this whole explainer, the rapid-fire revision. This is your cheat sheet. Let's lock in the key takeaways you need for the exam. Okay, let's go. Key dates and acts. Notified, April 15th, 2025. Phase 1 for governance, August 1st. Phase 2 for nominations, November 1st. And the 5 acts it changes? Just remember RBSBA-BA. Got it? Good. Now for the numbers. These are your multiple choice question magnets. Substantial interest jumped from 5 lakh to 2 crore. Co-op bank director term up from 8 to 10 years. Unclaimed funds moved to the IEPF after 7 years, and the maximum number of nominees you can have is 4. Memorize these figures. And finally, the key rules. Don't mix these up. Simultaneous nomination is percentage-based and for deposits only. Successive is priority-based and covers everything: deposits, lockers, and safe custody. Remember, PSB auditor pay is now set by the bank itself, and reporting moved to the last day of each fortnight. Simple as that. So, to wrap it all up, this quote from the Ministry of Finance really hits the nail on the head. When you boil it all down, the whole point of this act is to build a stronger, safer, and more modern banking system for India. And I'll leave you with this question to think about. On one hand, this law gives customers more power and flexibility. On the other, it puts banks under a tighter leash. So how will this double-edged approach actually change how much we trust our banks in the long run? That's the real $1 million, or maybe 2 crore question. Okay, that's all for now. All the very best for your exams.